Hello, everyone. Thanks for tuning in. This webinar recording is brought to you by Saturn Advice. We are recording it on 27th of July. We're really happy to have you here. I'm your host today. My name is Joyce, a financial advisor at Saturn. I do hope that you enjoy the next 30 minutes or so. So our topic today is mid-year markets outlook. For most investors, in the wake of 18 months of turbulent markets, it's natural to feel quite disheartened. Although the market has rebounded quite a bit year to date, is this trend going to continue? And what does it mean for investors' portfolios? In the meantime, the term deposit rate has risen to a level that we start to see a 5 and 6 handle on it, while the New Zealand inflation is still running quite high. So how do you invest your money in this new reality? These are the questions that we're getting from our clients. So we have a great speaker to help us dig into these questions today. So let me introduce you to Shahrukh Abdali. So to give you a bit of information, a bit of background, Shahrukh is a financial advisor at Saturn. He's also a CFA Charterholder. Shahrukh sits on investment committee. For most of you that get our newsletter, you will be quite familiar with him because he is featured on our monthly market commentary. So welcome, Shahrukh.
Thanks, Joyce. Happy to be here.
Great. Now, before I hand it over to Shahrukh, just want to call it out that all the information shared here today are general information only. These are not personalized financial advice because we don't know your personal circumstances. However, we do encourage you to seek personalized financial advice. Over to you, Shahrukh.
Thanks, Joyce. All right. Hello, everyone. So just before I get into the meat of things, a little bit about ourselves. So we are a group of companies. Me and Joyce sit in Saturn Advice. We specialize in investment planning and retirement planning services. We also have discretionary investment management service, which is a very efficient way of managing portfolios, particularly for those who do not want to be hands-on with investment decision-making on a day-to-day basis. The other part is Saturn Invest, which is a superannuation scheme which is qualified to accept pensions from UK, pensions getting transferred over. So if you have ever worked in the UK or you know someone who's worked in the UK, please get in touch. We can assist with the transfer of the pensions across free of cost. And the last one is a digital advice business for Kiwi Saver that's called National Capital. The best part is that the advice provided is for free, so it's like a no-brainer for you to get in touch and get some advice for the fee that you're already paying. Moving on, so Saturn Advice, which is where we sit, the business has been around for quite a while, more than 30 years. We've got 2 offices, one in Auckland, which is where the 2 of us are placed, as well as 2 other advisors. And then we've got a Christchurch office, and we've got 2 advisors down in Christchurch as well. So between the 2, we cover the country of New Zealand. Very experienced team, and typical clients include individuals, families, trusts, and companies as well. What makes us stand out from the rest is that we are a very impartial advice business. We do not take any commissions from any of the funds that we recommend. Neither are the advisors paid a commission on any new business they sign up. So there isn't a sales target hanging overhead. We're all paid a fixed salary. That really removes any conflicts whatsoever in giving advice. So, we are totally motivated to give the advice that's best for the clients without thinking of what we're going to get out of it. That aside, what I'll be talking about is, taking you through 2 different asset classes: international shares, Australasian shares, infrastructure. Also talk about property, but listed property, and then finally fixed income. And then we'll bring it all together in terms of how an investor should be thinking. So international shares, what I've shown here is the graph at the top left, which shows the major indices across the globe. S&P 500 is the US, Nikkei 225 is Japan, then I've got Europe and UK in there, and also 2 in emerging markets. So you can see that now with the markets having been strong the last few months, well, since the start of this year, have been a really strong performance, and that has pulled up the performance even for the 1 year as well as 3 years. So all of those returns are now positive. 6 months ago, when we last did this webinar, quite a few of those bars were actually below the line. So that's definitely a positive change for the investors who have been in the market through this year so far. What's going ahead? The global growth has been persistent, and that's been driven by consumer spending being quite resilient. So what I've found is that consumer savings are still there from the COVID period, where they couldn't spend and they were still getting paid either through the government subsidies or working from home, but they couldn't really spend that money. So those savings really built up during those initial couple of years of COVID, and that the savings have been diminishing, but they're still there, which means that the consumer spending has been quite resilient despite inflation biting in terms of cost of living going up, as well as interest rates going up, as a result of monetary policy being quite restrictive. But both of those two macro factors are now fading. Inflation has been declining, quite prominently so overseas than New Zealand, but I'll come to New Zealand just in a bit. And interest rates across the board appear to be peaking now. Most central banks are near the peak of their interest rate hiking cycle. Some of them have even indicated that this is the peak. New Zealand's central bank being one. And then some central banks have paused, suggesting that they'll watch the data coming out in the coming months with respect to inflation. If inflation continues to fall, that could be the peak. And then there are others who are still raising, but the pace of increments are now declining. So across the board, it is definitely nearing the peak of the cycle. What does that mean going forward? Macro factors are beginning to have less of an impact on moving the share markets, and the micro factors are beginning to take more center stage. What are micro factors? Well, primarily the company fundamentals. So give you an example. Previously, go back a year, if inflation figure came out high, that would sway the markets lower because it would indicate that the monetary policy will be a bit more restrictive. And then if the monetary policy came out restrictive, i.e., the central bank announcing a rate hike, that would bring the market down as well. Or if the central bank came out sounding a little bit less restrictive on the outlook, that would again boost the market, as was the case early this year. But now we had the US inflation figure come out for June a couple of weeks ago at 3%. So it's getting pretty close to the 2% target, while the economy is still persisting with growth, which is a really good combination. But the market really took it on the stride. It didn't particularly go up as a result of that inflation figure being so low. And then overnight we had the US Fed hike the interest rates by 0.25%, but barely had any impact on the market again. What has been having an impact is earnings announcements. So Meta, for example, came out with their earnings overnight, and that was a beat. And the market, the share price for Meta has gone up by 7%. Similarly, some of the other companies that have missed their mark, like Netflix, missed their mark, and the share price dropped by a good, high single-digit number. So that is what is going to be driving the share performance going forward. And this is a perfect scenario for active managers to really, come to the front with good, solid research, identify companies which are going to provide solid earnings going forward, and stay away from companies which aren't going to, meet the expectations. Yeah, but something to be mindful. I've had a fair few questions about the regional banks in the US. The failures that happened and what potentially might be coming. So, look, business failures are a very, very normal part of the economic cycle. We are still. I feel that we are in the late stage of the cycle, but hey, it could not result in a broad spectrum recession the way it seems. What could happen is a rolling recession, which means that one sector goes through a recession while the other sector is still holding up. Then the next sector goes into a recession while the other sectors are holding up. So across the board, the economy never really tips over into a recession, but different sectors get affected at different stages, and the overall economy still sort of holds up and then goes on to the next upcycle. So yeah, whether or not it's a good time to be sitting on the sidelines waiting for an opportunity to jump in versus now, is a good time to invest. It's, a personal call, but I would encourage, the audience to really think long term. Over the long term, the shares offer really good value, and the markets are forward-looking. So, a lot of what is coming might already be priced in, and any weakness might already be in the share price as we stand right now. And to be fair, I mean, the share prices are still below the peak that was in December 2021 for many companies. I mean, some companies are obviously at record highs, but there are very few of those, mostly in the technology sector and within the artificial intelligence space. But good thing is that the share market value is now broadening out away from the technology sector, and more of the other sectors are beginning to perform really well. The consumer discretionary is picking up. Cyclical sectors are also picking up, which includes the banks, the industrials, as well as the healthcare sector. Smaller caps, the smaller businesses are also doing well, which is a really good sign about the strength of the underlying economy, and that gives a lot of tailwinds for the rally to continue on, sustain itself going forward. So while technology might not be performing, there could be other sectors that will now be driving the market forward over the coming months. So yeah, it's still a pretty good time to be jumping on the ship and not really sitting on the sidelines. That's on international shares. Yeah, sure.
So, I mean, you're absolutely right, Tom, because some of the fund manager kind of called out this advance in the major indices has a lot to do with the AI hype. And people do argue that is it sustainable? So from what I'm hearing, from your perspective, you think the trend is kind of broadening out to other sectors.
That is correct. As well as even for the technology sector, the only reason for, I expect that technology might be going a bit flat, not necessarily declining, is the fact that they've had such a strong run so far this year. Some of those companies have doubled in their valuation, and doubling of valuation in a very short period of time often is followed with a digestion period where the market then digests that appreciation and then waits for that appreciation to be followed with earnings growth. And the earnings growth is coming. As I said, Meta is pretty active in the AI space, and they have come up with an earnings beat. Microsoft came with an earnings beat. So these companies are delivering, but the level of appreciation they've enjoyed means that it could be followed with a few months of sort of flattish to maybe not appreciating as much. But on the other hand, you've had all these other sectors which were absolutely flat over these recent months, now beginning to pick up because the consumer spending has been resilient and the economic growth has persisted. So that growth is now spreading across other sectors, and the other companies in other sectors are beginning to deliver, good solid earnings, which has now started resulting in their share prices going up. Yeah. So that is a really good, healthy sign for a sustainable share market rally.
Yeah, thank you.
For Australasian shares, which is New Zealand and Australia, you can see the bar chart on the top left, Australia obviously has been outperforming, and that is in a way, for those of you who have been following my monthly updates, I have been suggesting that New Zealand has got its indigenous problems, which will hamper economic growth going forward. And we are beginning to see that even in the share market performance across the two countries. Consumer spending has been key for both, and it is slowing by the looks of it. Inflation is still very much there for both these countries. New Zealand's inflation as for June was 6%, and incidentally, so was Australia's. That came out yesterday. And it came out at 6.0% as well for the June, for the year-on-year June quarter. Compare that to the US, which is at 3%. So obviously we are dealing with higher inflation, and the target is still a far cry from it. So consumer spending has still been resilient, but it is beginning to slow. The cost of living is beginning to bite. The fuel prices probably have come down a little bit over the recent months, but still higher from 2 years ago. But mortgage costs, for example, have really gone up like 2 to 3 times of what they were 15, 18 months ago. And that is beginning to really have an impact because a lot of mortgages were fixed over the last 2 years are now coming off those lower rates and now rolling over into much higher rates. So suddenly consumers are beginning to find that they don't have as much discretionary spending as they had previously, which means that the business activity levels are beginning to drop, and there will be also the negative wealth effect, especially in New Zealand, from falling house prices. There are a lot of investors out there who would be feeling the heat from the falling house prices, but even owner-occupiers, it's just the psychological thing when you feel that your house price has gone up and that much equity is there in the house. You're not accessing it, you're living in the house, but it's a psychological thing that suddenly that equity is now shrunk materially, and could even be, for those who bought the house last year, it might already be into negative, depending on how much deposit they put in. So that kind of mentality puts you on the edge, and you really hold back on your spending and curtail on discretionary spending. So that will result in business activity falling off or trailing off. Business profits fall. That results in businesses looking to cut costs by laying off people, not hiring as much. And that sort of starts the circle of the economic activity going down further. So macro factors may have peaked across these two economies as well. Inflation has peaked. The peak for New Zealand was 7.3% in June last year. For Australia, it was 7.8% December last year. Both these countries are now seeing decline in inflation, but the decline is still pretty slow. It may be that as the economy slows further, it helps bring inflation down faster. And particularly for New Zealand, 6 months ago when we did this webinar, I pointed out that I expected a recession for New Zealand mid of this year, and voila, we are in a recession right now. At least technically, it's a small number. Minus 0.1% GDP growth is almost a technical, rounding error. But I think that the recession is going to worsen over the coming months, and we will see more economic pain for New Zealand, at least in the coming months. So that the positive side of that is that might help bring inflation down much faster. Right now at the rate it's coming down, people are saying that it's not going to come down, say 2025. I feel that probably second quarter, by mid of next year, I think we will see inflation close to target, if not within that.
We'll mark your word for it.
Yeah, well, we'll see. We'll keep doing this every 6 months, so we will see. But central banks are going to maintain a pretty restrictive stance until inflation is near target, which means that essentially they might be edging the economy towards a slowdown, both New Zealand and Australia. But Australian central bank is just a wee bit less restrictive on a relative basis to New Zealand. Micro factors, again, will start to take more center stage. Earnings will get affected, particularly in New Zealand, because of my expectation that recession is going to worsen here. Consumer staples and utility sectors are defensive in nature. For, if you are looking to handpick certain sectors, well, those sectors might be a bit more defensive. Banks may see suppressed revenues across these two countries, mainly because banks here, as well as in Australia, have a large chunk of their income through lending. And lending activity does get affected when economic growth slows down, particularly like, in the mortgage space. There won't be as many people who would be able to afford mortgages at the current mortgage rates. And if the economic growth has been slowing and income gets affected, well, then again, you will have problems in terms of mortgage sales, which is already beginning to pick up in New Zealand and might worsen over the coming months. So yeah, banks will be dealing with some bad debts as well as suppressed revenues, as they won't be having as much demand from mortgage lending as well as business lending. Resources sector in Australia has benefited from China coming out of their COVID zero policy late last year. So that definitely picked up demand for the resources, but they also recently have started to see a lot of demand, for lithium, and that's EV sector continues to expand. But interestingly, what happened during COVID, EV manufacturers hoarded lithium and they built up inventory, anticipating that there'll be a huge demand and they won't be able to access lithium, and that those inventory levels are now more normal and dwindling. So suddenly they have started to look at exporters of lithium, and Australia is one of the bigger exporters in lithium and growing. So that has benefited Australia from that respect.
So from an investment perspective, particularly in terms of asset allocation, given that there are some indigenous issues in New Zealand that the recession is likely to worsen, what would it mean for investor from a asset allocation perspective then?
Look overseas, in plain and simple terms. Do not be invested largely in New Zealand, especially if you are living here and earning your income here. Do not be invested as well, just in New Zealand. And there are certain outfits, advisory outfits, who would be, giving advice. I've seen, I'm not going to name for obvious reasons, but they have a strong bias to New Zealand. And if you, you already have an investment portfolio, you just have to have a look at it and make sure that it hasn't got a large allocation to New Zealand shares and New Zealand fixed interest. If it has, I strongly suggest you should be questioning that and diversifying it overseas, because there are just far more opportunities overseas, much broader spectrum of industries, as well as the size of companies that you can invest in overseas is many folds compared to what you have here in New Zealand. So yeah, and if you're a property investor in New Zealand, well, again, it's just a mindset thing. Property is considered to be a safe investment, and you can see it, you can touch it, but at the end of the day, you're still really concentrated in your exposure, one sector of one country and a really small country, or on the global landscape.
Right.
All right, infrastructure. So you can see the graph there. It's been positive, but what's important to understand about infrastructure is it is a defensive asset class on the equity side, and that's because it's largely composed of income yielding assets. And what type of assets? Well, so airports are one type, and airports have had strong revenue over the recent 2 years. Well, probably ever since the first year or two after COVID, once the world started to move past the initial lockdowns, the demand for travel really picked up, and it has persisted all the way through. There is absolutely no sign of that travel demand to be softening as yet. So, the coming months could still see really strong revenues coming in for airports, from all the foot traffic, as well as, airlines are still resuming pre-COVID routes, which were, curtailed during COVID. So, but over the medium term, I do expect that at some stage within the next, well, again, it's tough to see because I expected by this time, things would be normalizing a bit, but they haven't yet. It could be that within the next 12 months, we could see this pent-up demand start to normalize, which would, relatively speaking, negatively affect aeronautical revenues for airports. So, yeah, over the medium to long term, it will be a bit more normal, but at least for now, airports are really enjoying some heavy demand. Toll roads and bridges is another type of infrastructure asset, and their outlook is pretty stable. It has been so, ever since the world came out of COVID. People are still using toll roads and bridges and are expected to continue to do so. So there isn't really a lot changing on that front. Energy infrastructure is another subsector within infrastructure. And that is very much reliant on the price of oil. If the price of oil goes up, the revenue for the energy infrastructure goes up, and vice versa. So the price of oil has been supported with OPEC supply cuts earlier this year, which have caused the price of oil to spike and then sort of normalize. And the normalization is realization of the fact that, well, the demand might not be sustaining itself over the medium term, and that's potentially, or at least partly, driven by the slowdown in the Chinese economy. And why is that important? Well, the Chinese economy, or China as an economy, is the largest importer of crude oil in the world by some distance. So with that economy slowing down, there are concerns that the price of oil might be negatively affected because the overall demand might be a bit more suppressed. Lastly, you've got utilities infrastructure, and that is one of the most defensive types of infrastructure asset, simply because even if there is, a pandemic or, a recession, you won't stop using power and water. And, if you are still using power and water, then the utilities infrastructure is still getting the revenue because it's still getting used. So oftentimes they're also regulated in terms of their margins, which provides stability to their margins. So yeah, it's a very defensive subsector within infrastructure, and very stable dividend yields mostly out of that.
Right. I think it's worth pointing out, when we ran the webinar 6 months ago, international infrastructure probably was the one of the best performing asset class, right? So it's like, that's why you have a diversified portfolio. Any sub-asset class, they go through periods of outperformance and underperformance.
Yeah, absolutely. And to be fair, infrastructure was one of the worst performing, sectors as a class immediately after COVID, because nobody was using the airports or toll roads or bridges, and even the energy infrastructure was sitting idle for most part because factories were shut, cars weren't running, there wasn't enough demand for oil. Might recall that the price of oil briefly went into the negative, in 2020, but that's
crazy times.
Yeah. So it was just the utilities infrastructure that was holding up, but as an asset class, it had one of the worst performing, numbers through 2020. But of that small base, the negative base, 2021 and then 2022 were really, really positive, while other sectors were pulling back. This sector was the shining star. So yes, absolutely right. Diversification is the key. If you spread yourself across different asset classes and across different geographic regions, it really does smooth out your journey, which is quite important.
Yeah, that's what we want.
Yeah. Okay, listed property. So first and foremost, I'm not talking about residential property. It's really interesting for most people to get some insights on residential property, but that could be a different discussion altogether. So here, talking about listed property, which is mostly commercial, and what I've shown here is the New Zealand, Australian, and global listed property in that graph. And you can see a bit of a mixed bag picture, apart from Australia, which has had a really decent run over the last 3 years. New Zealand is been positive for the last quarter, but the 1 year and 3 year numbers aren't particularly good, and same for global. It's had a really tough 1 year, and that's largely down to the aggressive interest rate hikes here in New Zealand as well as overseas. Australia, as I have mentioned, on a relative basis, their central bank is just that wee bit less restrictive. They paused in March, much to the surprise of everyone, and they've paused again now, which is again a bit of a surprise. So that has helped the valuations of commercial real estate in that country. So that's why they are a bit better performed, better placed on that chart. But the peak in interest rates, as I've said, that most central banks are reaching the peak if they are not there already, which means that the headwinds on the valuations are going to ease up or will continue to ease. So expect a bit more upside on the valuation front for commercial real estate. However, caution for New Zealand, the recession, as I've said, is expected to worsen, which can hamper revenue. So tenants may struggle to maintain the rental payments. Again, talking about commercial tenants, small businesses. Business failures mean that you will lose, the rental income on the commercial property, and it could sit vacant for months until another business comes in and leases it out again, as is the case often during a recession. So New Zealand, in general, I would expect the commercial real estate would underperform Australian commercial property as well as global listed commercial property. Within the subsectors, retail across the board is at risk of slower consumer spending. Consumer spending has been resilient, but it is slowing, particularly in New Zealand and Australia. So that would have an impact in terms of the shopping malls and shopping strips, not having as much foot traffic and seeing some downside to their revenues. Office space is obviously still adjusting to the different post-COVID era where you've got the hybrid approach, and that is here to stay. There has been a bit of a rollback from companies allowing employees to work half the week or most of the week remotely to now wanting them to spend some time in the office again. But I can't see a future where we are back to the office completely, working 5 days a week. So this hybrid approach means that the overall total demand for the office space subsector is less than what it was pre-COVID. Now, what that means from the investment point of view, the new developments that have been in pipeline over the last 2-3 years are now coming online. They will be attractive. They will still be sought after, but at the cost of existing office space. So there are some good options for fund managers in this space to look at new developments, modern facilities, good locations, and capture some upside in the future for that. But they will have to be really cautious about holding on to some dated office space, and because that is unless they invest a fair bit in renovations, it's not going to be that sought after and might stay vacant. Industrial property, that's industrial and logistics assets, warehouses, as well as logistics related assets like the shipping containers and offloading the ports and everything. Those will continue to see a fair bit of demand, simply because e-commerce continues to advance. It really ramped up during the COVID lockdown period because people couldn't really go to shopping malls or do physical shopping, so they relied on e-commerce. But that trend is continuing on, so there is still going to be a fair bit of demand for warehouses as well as logistics assets. Also, businesses realize that supply chain bottlenecks can prop up and really cause problems in inventory management during COVID. So a fair few businesses have learned that it's always a good idea to maintain a bit of inventory on hand to smooth things out. So I think there is going to be continued demand in that subsector. And lastly, I want to point out, and this is more overseas than New Zealand and even Australia, is technology property sectors, property assets. And what I'm talking about here is the telecom towers as well as data centers. There was a report I was looking at which suggested that data centers are getting picked up even before they get fully completed because these large technology businesses have got so much demand that they are going to lease those data centers for the next 30 years, even before they get completed. So that sector is absolutely red hot. The price appreciation is happening. And you can get access to that through the fund manager that we use for global listed property rather than just focusing on New Zealand. So there is a lot more diversity, again, overseas than just focusing on New Zealand. All right, fixed interest. The graph looks a bit sick there, on the top left, and it's a very unusual still. The period that we are looking at, the 3-year return being negative and materially negative. It's improving. It still looks pretty negative, but compared to say 6 months ago, the 3-year return is now -3%. 6 months ago, it was -5% or something like that, -6%. So it is improving because the recent returns have been turning positive, and with interest rates as high as they are now, the yields being offered by this sector is now a lot more attractive than it was for the first time in a long time since the global financial crisis. Now you can invest in quality fixed interest and still expect to get a reasonable yield. Previously, if you wanted a reasonable yield, you had to drop down on the quality spectrum and go into low quality or higher risk fixed income securities on offer. And with interest rates peaking, that also means that there is a bit more upside to the valuations. It's just an inverse relationship with respect to valuations and interest rates. So, with interest rates dropping, it will be good for the valuations, at least, from sustenance point of view. So those returns, the long-term returns, will continue to improve. And most importantly, the volatility with the international fixed interest and fixed interest in general is low compared to the shares. So it is a really, really good diversification play to include some fixed interest to your overall portfolio mix to dumb down the volatility from the equity side, which is obviously a bit more volatile on a short-term basis.
Yep. Just on the fixed interest front, Tom, so we use active fund managers. Yep. So what kind of role do you think an active fund manager would play in the current market?
So as in like what would play now? Well, right now it's a bit of a more stable place with interest rates now peaking. But a year ago, active managers within this space had a massive opportunity to play with the duration. Even now, most active managers will be locking in the duration, and duration is like how long term do you fix your yields, and they will be fixing the yields for the longer term now compared to staying with the market because the interest rates are peaking and they're expected to go down over the coming months and the next couple of years. So fixing the yield now near the peak for the longer term helps maintain that yield and provide the price appreciation as the market rates drop over the coming months and the coming year or two. And go back a year or so with the expectation that interest rates will be rising, they could shrink the duration. Even we had one manager that using some levers went into the negative. So they actually shorted, and what that meant was with interest rates rising aggressively, valuations would drop and they would make money because they were short in terms of their exposure. So active managers always can add this little bit of extra return on top of what the market is experiencing if they are doing their job properly. And that's what we specialize in, choosing the active managers based on the processes that they follow in making investment decisions. So yeah.
Thank you.
No worries. New Zealand fixed interest, more of the same story, except you can see that in that graph, the New Zealand returns are a little bit more on the downside. Valuations are recovering, as I said, with interest rates again peaking here in New Zealand as well. That is a headwind that's off the table, at least it seems for now, unless inflation really persists and RBNZ has to go back on their words and start raising the rates again, the OCR. So in absence of that, I expect that the valuations will get some support, will continue to get some support. There is a floor. However, as I've pointed out, if inflation persists, we could have a bit more downside risk. And then obviously with New Zealand, recession getting worse means that there might be some more business failures. So business failures could result in defaults on fixed income. So there's a bit more downside to even fixed income in New Zealand than globally from on relative basis. But not to suggest that any panic and you need to just run out of New Zealand fixed interest. If the fund manager is doing the job well, they would have invested in fixed interest in really highly rated and stable businesses, which may be able to weather the coming economic slowdown pretty well. So bottom line, the yields have improved materially from say a year ago. So now you can get some decent yield, and it provides a bit of a buffer against the share market volatility over the short term. What I've shown in the bottom right there is the term deposits rates as well. And you can see that they have come up quite sharply, but they're just beginning to, sort of peak. And inflation has obviously started to come down as well. And I would expect that the term deposit rates will follow. Remember, term deposit rates are looking pretty attractive right now, but it's a cost to the bank, and the bank would not want to keep the cost high longer than they absolutely necessary for them to do so to attract business. So if you have term deposits or they're coming off, it might be worthwhile to consider locking it now, or talk to us, because we've got some other options, and you could be investing into a portfolio that enjoys the bull run over the next few years. Do not look at the performance of your portfolio over the last year and compare it to the return that you can get on term deposits going forward, because that's comparing your future potential return with the past returns, just not an apples with apples comparison. Look at what you could have made. I mean, yes, granted, term deposit rates weren't negative, and portfolio returns could have been negative over the last year or so, but going forward, it will outperform the term deposits. Absolutely. We won't be in business if that wasn't happening. I have talked a fair bit about the importance of diversification, bringing it all together. You need to be diversified, not just across different asset classes, but across geographic regions. It is very important to diversify away from New Zealand, particularly given the near-term outlook. But just a good portfolio construction theory that would suggest that it's not just about asset classes, but also geographic regions. So if you can do it yourself, please do so. If you need help, we are here to help. You can reach out to us. One more thing that I want to point out here is that we have an alternative to cash in bank, which is a call account with a major bank in New Zealand that earns the OCR, which is currently 5.5% gross of fees. The beauty of this arrangement is there is no fixed term or locking period. So compared to the term deposits where you're locked for a few months or a couple of years, this can be accessed within 24 hours. without foregoing, your accrued interest. So it's not for someone who is happy to leave the money in the bank for 12 months or longer than that. But certainly, if you wanted, be able to access the cash while still earning a decent return on it, well, you can reach out to us and we can talk about this. I have shown this graph previously, but I've got this updated version. So, it's you can see a little bit of upside at this, value on the rightmost side. We've had this down cycle for, about 1.5 years. It says 1.2 years because this graph is until end of March. But, the returns have continued to be really positive since. So we are very much close to this baseline and at the cusp of moving on to the next mountain, which history tells us continues on for a good 5 years, if not longer. So, hey, we are at the cusp of the next mountain, could have some really solid returns for the next few years. Do you really want to sit on the sidelines? Reach out to us. This is the performance of the strategies as of June. I would argue that this isn't particularly representative, especially the long-term returns. The 3-year and the 5-year returns are looking a bit weak, which is understandable given that we've had COVID during this time period, and we've had a strong run for the 1 year, which you can see the 1-year returns are a bit more positive than the longer-term return. But to put things into perspective, these numbers really can change depending on at what point you're looking at them. So go back 2 years and the returns were like this. So obviously you can see the 1-year returns were absolutely mind-boggling. The aggressive number was 25% north of that. Even the 3 and the 5-year returns were like, strong double-digit returns on an annualized basis. And at the time when I was, giving this presentation, I said, look, this is not representative of the long term. We've had a really, really strong run, post-COVID initial period, and before COVID also we had some really good years. So this is not sustainable, and so is this not sustainable. So even these numbers are a bit on the lower side compared to what I believe is the long-term normal. So don't think that this is what you can get over the long term by investing, in a portfolio. This is at this point in time, it's looking a bit weak, but that's not the long-term return. You
kind of looked at the worst case scenario and the best case scenario, while in reality things tend to be somewhere in between.
Yeah, exactly. Yeah. So it's the long-term return for the growth strategy 3.6 versus 12.47 will likely you'll be somewhere in between. So high single digits, somewhere there. Yeah, so that's about it from my side. Joyce, any questions for the audience? Well, those are the details. Reach out to me personally or the business, and we can absolutely address those questions or have a discussion about your financial circumstances or what you want to achieve.
Yeah, fantastic. Shahrukh, it's always nice to listen to you. We were hoping to pack this down in 30 minutes or so, but we underestimated our passion when it comes to talking about investment markets. So thanks to everybody who's listening.
Still.
Yeah. And like Shahrukh said, if you need any help with financial planning, I'm reaching out to Shahrukh or myself. And if you have a portfolio and you have doubts or not sure if you've got it invested in the right place and you want a second opinion, please do reach out to us as well. If you like what you hear, go onto our website, saturnadvice.co.nz, and you can subscribe to our newsletter. So we send it out on a monthly basis where you will get Shahrukh's monthly market update. We also introduce the human side of financial planning as well, talking about, we're on webinar talking about retirement planning and all sorts of stuff. So thanks for watching until this point. Have a great day. We'll see you next time. Bye.